Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's look ahead to the ECB interest rate decision taking place on Thursday, the 7th of March. Certainly plenty to sink our teeth into. It comes off the back of the inflation gauge last week from the Eurozone. And people really starting to look for clues from Christine Lagarde, who thus far has been hesitant to provide them, that we're going to see an interest rate cut in the coming months. Let's get into some of the charts. First and foremost, I wanted to give you an overview of exactly where things stand in terms of inflation. You can see here with the purple line, the Eurozone reading of 2.6% is the lowest of these major economies, apart from Japan, which has remained low throughout much of this period. And so does that provide the basis for the ECB to cut interest rates before the others? That remains to be seen, but I think they're certainly in a good position to do so. And if we look at this breakdown that I often provide in terms of the inflation metrics over in the Eurozone, what we can see here is that essentially you're looking at 2.6% at the moment. But if you look in the middle section, the next two numbers that are dropping out, the first one's 0.9%, right? So we've got 0.6% to get back down to 2%. There's a good chance that we're going to be there next month, quite frankly. And that means that the ECB are going to have to start preparing markets for any potential action that they're going to take. Are they going to remain hesitant? Well, look, the 10-month annualized figure at the moment points to, in 2 months' time, us potentially being around 1.2% if we continue on the trajectory seen over the past 10 months. That points towards the need for the ECB to change tact and to do it very quickly. They don't have much time to be able to make these changes in terms of shifting market expectations. And therefore, the question mark is, will we see it on Thursday? I think there's a good chance that we do need to see the ECB change their tack. One of the main reasons that they're utilizing as a sort of the basis for them to hold off for some time is wages. And we can see it here, the breakdown in terms of wage growth and wages in the region remains a problem, still well above that inflation rate. And when you've got wages above inflation, it's good for real earnings. But that increase in real earnings actually creates inflationary pressures within it. And that must be a concern because at the moment they're trying to remain hesitant. Certainly, there's even bigger problem of this over in the UK, but certainly wages are an issue that the likes of the Federal Reserve, the Bank of England, the ECB, all will have to tackle because despite inflation falling, wages have remained relatively sticky. And that can create a sort of inflationary spiral that ultimately leads to prices moving higher in the medium term. This is a breakdown of a survey undertaken by Bloomberg. And what's interesting here is the major concerns that they have for the Eurozone aren't necessarily associated with some of the big issues, and in particular, sort of economic side of things. It's more the resurgence of inflation, things like the Ukraine war, geopolitical tensions, all of them are inflationary. Inflation, of course, is the top section of that. But the resurgence of inflation remains the top or one of the top topics for people when they look at the Eurozone. And that highlights why the ECB remain relatively steadfast in their approach to driving down inflation, despite the fact that, in my mind, they've pretty much done the job, right? They're going to hit 2%, whether it's in a month's time, they'll hit it within 2 months' time, in my mind. And therefore, inflation to get back to down to target at the moment looks to be solved. There's clearly some concern whether it comes to wages or whether it comes to sort of underlying sticky inflationary pressures. There's still concerns that even if we hit that 2% target, that we could start to see another move higher after that. That could cause a more cautious approach from the ECB, but that's going to be one of the key elements to be looking out for this meeting. Another element to be looking out for is the fact that we have new forecasts coming from the Eurozone or from the ECB. And the outlook for inflation and the outlook for growth does point towards potential downside moves for both. I've got that highlighted with the next slide from Bloomberg, where we've got estimates from economists, they all point towards the idea that we're most likely going to see either unchanged or a downward revision in terms of the numbers. More so, it looks like it's geared towards the near term, where we're likely to see downward revisions in terms of growth, downward revisions in terms of inflation, and that highlights the moves that we have been seeing of late. Over the longer term, people are more confident in the outlook, by and large, because of the fact that we don't necessarily know what's going to happen further out. There's a good chance that these numbers are completely wrong, but we're a couple of years away from it, and therefore markets are less confident. They are more confident what's happening at the moment, and they think weaker growth, weaker inflation, and by and large that points towards a quicker return to monetary easing from the ECB. In terms of the outlook, according to the Icon platform, the London Stock Exchange Group platform we have here, you can see that markets are currently attributing 5% chance of a rate cut this time around. So not much chance. So we're expecting to see rates on hold, and therefore the outlook for future rate cuts and inflation and growth becomes particularly key for this meeting. April, we have a 21% chance that we see rates lower than they are at the moment. And then June, because we've got that gap in May, it really allows additional time to really feed some of these numbers through into the economy and provides people with greater confidence that, well, look, June, we will see rates cut. For me, I think there's still a good chance of April. I mean, markets attributing just a 21% chance of it. But if we were to see inflation drop below that 2% target prior to that meeting, I would say that this would be much higher than 21%. So what might that do for markets? Well, let's look at a number of different markets that might be impacted by a potential dovish shift this time around. We don't necessarily know that it's going to happen. We do know that inflation is moving towards the downside. There's a high likeliness that we're going to see a downward revision, as people are expecting, in terms of growth. Downward revision in terms of growth, a downward revision in terms of the outlook for inflation. Both of those would be deemed dovish in nature. And then the possibility of the likes of Christine Lagarde laying the groundwork for an interest rate cut in the coming months. So all of those would be deemed dovish, and all of those would potentially feed into euro weakness. First and foremost, I wanted to show you this picture. This is an outlook for the trajectory of different currencies over the course of the past month. Not the past month, the year so far, sorry, year to date this is. What you can see is the euro is in the middle of the pack here in the orange, largely unchanged after some weakness early in the year. We've been sort of picking up ground recently, and that sort of regaining of ground does really point towards a shifting back in terms of expectations from markets for when that first rate cut might happen and the steepness of those rate declines. So we have been seeing some strength coming into play recently. It's also off the back of a weakening US dollar picture, as you can see here. You know, the topping out here in terms of the US dollar comes as all of the other currencies start to bottom out here, and some of them that had been relatively oversold started to regain a bid. Well, the question mark is whether this is going to be the beginning of a period that sees the euro coming back into the fore, as the possibility of the ECB being the first major central bank to cut interest rates comes into play. Now, this is a wider picture in terms of some of the main currency pairs. And what we can see here for the euro is that we have been seeing strength recently. You know, we can see strength against the US dollar of late. We can see a sort of regaining of ground for euro sterling. Euro yen has continued to push onwards and upwards, but that's very much a yen story as well. EURCAD also breaking through resistance, as we have here, or trying to break through resistance. Then Euro Swissy again pushing higher. Euro Aussie, Euro Kiwi largely sort of range bound, but regaining ground over the last week. So by and large, the euro has actually done relatively well of late. So the question mark is whether the ECB will be able to change that, or whether we're just going to continue on that tack. Let's grab a few of these to look at in greater detail. First and foremost, Euro sterling I thought was interesting because we're seeing some weakness coming into play today. You can see rolling over here, and you can see this sort of what looks like a sort of topping pattern here around this resistance level. So are we looking at this big double top formation? Well, for the time being, we're focusing on the ECB, but the Bank of England are in a relatively similar position. Markets expecting to see them cut rates around about June time, and inflation looking like it's going to tumble over the coming months. The inflation rate in the UK looks significantly higher than the ECB's, but I think that's going to change relatively quickly. Nonetheless, we are looking like we're rolling over here. So this could be a pair that for the time being, if we see a relatively dovish stance from the ECB and we see downgrades in terms of the inflation and growth outlook, that could cause this resistance level to hold up as it is at the moment and potentially roll over and head back towards your 85.28 level. Another pair that we were looking at here, I believe it was EURCAD. Yeah, let's look at EURCAD because it's an interesting one. We have been seeing the price of oil coming off today. That comes despite the fact that OPEC decided to extend their production cuts for another 3 months. Markets pretty much just shrugged at it, but nonetheless, we have been seeing strength for energy prices of late. This is EUROCAD on the hourly time frame, really pushing onwards and upwards. So it's certainly in a good way at the moment. I just wanted to highlight what I'd seen in that other chart where you can signal that you can see that we've come into this big area of resistance. Now, it's worth bearing in mind that we now no longer create these lower highs because of the fact that we've broken up the 147.35 level. But nonetheless, we're at a big area of resistance. It's just an area that if we're looking at a market that could potentially roll over, if we start to see crude strengthening once again, which it was coming into this this week, and if we see a dovish stance from the likes of the ECB, this could roll over. But certainly, it's notable that a number of these charts have shown euro strength. The question mark around that is, is that just a particularly good setup for that euro strength to reverse around this meeting? We could have seen massive downside for the euro, and some might say, well, it's already been overplayed because people are expecting it. So a potential change in tack from the ECB could be an interesting one, and potentially see this resistance zone hold, and potentially for the likes of euro sterling, as we said, could possibly see this resistance hold once again and start to roll over back towards support. So those are the two charts I wanted to show you on that front. And then finally, looking at the DAX, things a lot clearer when it comes to the equity markets, in particular, those markets that continue to hit record highs. The DAX on the hourly time frame, you can see here sort of consolidation mode at the moment. Let me just grab a rectangle, just show you exactly where we stand. So look, what we're seeing at the moment looks very similar to this, looks very similar to this. If I can get it on here, there you go. It's very similar to this. We've been seeing sort of stepped move higher. We see these retracement phases and we ultimately push into record highs. At the moment, we're heading lower. We don't necessarily know how low this is going to go. We could pull back into here, or this could be the low. I would say that the key thing is to be looking out for this sort of reversal of the lower highs in particular. Once you start to break up through a price swing high, as you've seen here, that breakup through structure starts then creating higher highs and higher lows, and ultimately pushed us into record highs. At the moment, you can see that we still are creating these sort of lower highs and lower lows. So at the moment, if we were to break up through resistance of 177.67, that would point towards this sort of consolidation retracement phase being over, and we push into record highs. But we haven't done that. So until this happens, we could see this market roll over once again as we sort of take a breather and head into this meeting. But if we're seeing the likes of the ECB pointing towards the possibility of a rate cut, maybe in April, and certainly June looks like the one that everyone's looking to as the initial mover, well, that could be positive for equity markets. And the DAX certainly of late has been performing particularly well. And the job of a trader sometimes for people can be a case of trying to decipher the impossible. And sometimes, in my mind, the job of a trader is to try and find the path of least resistance. And if that means a market that hits record highs on a daily basis and waiting for retracements and finding entry patterns within that, that can be a particularly good way to play the markets in my mind. Nonetheless, that has been my roundup for what to expect for the ECB meeting. Keep a close eye out for whether Christine Lagarde opens the door for that April meeting, because she has to understand that there's a good chance we're going to break below 2% inflation next month. And if that happens, whether she alludes to them moving in April or not, markets, I think, would likely see a significant shift towards that. Would that lead to euro weakness to a substantial degree? Who knows? Because we're seeing a lot of central banks moving towards rate cuts in the coming months. So they're not necessarily a huge outlier. It would just be a possible earlier rate cut than some of the others. But the markets that would likely do well out of it would be the likes of the DAX, which would undoubtedly look forward to a period where we see greater economic strength and a rebound. And the German economy in particular has been suffering over recent years. And I'm sure those trading the DAX will be looking forward to a period where we see the likes of the ECB trying to aid and push forward the German recovery story rather than hinder it with sky-high interest rates.